So 2018 was the last time the Federal Reserve stopped raising rates. They didn't cut until, I think it was August 2019. So what happened was the moment the Fed went on hold, the markets went on an upside rampage. They were down kind of 30% and then they recovered, so not wildly dissimilar to now. And if I look out over the next year, well, the S&P did about 10%. The NASDAQ did about 14%, kind of those growthy tech stocks, the kind of ARK style stuff. They did about 18%. So that was good. Bitcoin did 100%. And that's after it had gone up 400% and corrected. So, and even that didn't take back the all-time high. It took the following year for the all-time high to take out. So I think it's going to be a positive year, but that kind of choppy year where one minute you think, oh my God, it's going straight to the high. Then it's like, oh my God, it's gone back down. We're all going to die. And then it stabilizes. And it's generally, I think we'll look back and go, okay, we survived and we've actually made some money again, or made some money back. Let's put it that way.
Raoul Pal is a highly respected economist, investment strategist, and financial media entrepreneur. He is the publisher of The Global Macro Investor, a macroeconomic and investment strategy research service, and the CEO and co-founder of Real Vision, a financial media company that provides in-depth analysis of the global economy, finance, and markets. With a wealth of knowledge and experience in the field of economics and finance, he is a recognized expert in the industry. Today, we will be going through Pal's views, or rather his macro outlook on various sectors of the economy and global market. Pal is very optimistic about the future of cryptocurrencies and other digital assets, and as you would see in this video, he is also bullish on some circular trends, which he pointed out does well in the present market environment. In an interview last year with Cointelegraph, Raoul Pal said that he believes that the current bear condition of the crypto market will end only after the Fed loosens its hawkish monetary policy by halting interest rate hikes. According to Pal's predictions, we could be seeing the Fed loosening its hawkish policies, and we may be getting ready for a crypto rally in the next few months. However, irrespective of the indicators and the global market's overall bearishness, Pal believes that the worst is behind us and we would be entering a period of bullishness in the coming months. He also speaks about gold, cryptocurrencies, other trends that he is bullish on, as we would see in the video. Please ensure you hit the like button, subscribe, and drop your comments below. Enjoy the video.
Look, the world is driven, this whole space is driven by liquidity and network adoption. So the adoption of blockchain technology is ongoing and relentless, but the liquidity of how much money's around drives the space. So once you understand that, you understand a lot about the space. So last year was a massive withdrawal of liquidity. All the money came out, the central banks were tightening rates, all the banks stopped lending money, all of that stuff. And it meant that all assets went down, and crypto goes down the most because it's the kind of longest duration, highest risk asset. So where are we now? So here we are right near the end of the rate hikes. The economy is probably going into recession, and pretty soon. And so what happens is the market starts to look forward and say, maybe they'll stop tightening liquidity and take the foot off our necks. And maybe things, because our job in financial markets, particularly in macro, is to live in the future. Looking around today is useless. But looking around, what is the world going to look like in 6 months' time? Are the Fed raising rates in 6 months' time? Almost a 0% chance. Because inflation has peaked, growth is falling, we're going into recession. Normally, they would cut rates at that point. Now, they might be a little bit slow to do that because they really, really want to see inflation lower. But it means that the rate of change of all these rate hikes and all this bad news starts slowing down. I think we have a recency bias. So we talked about the Federal Reserve with their one ghost. Of your generation is 2008. The ghost of my generation is 2000. All these VCs who are a little bit older, who are in their kind of 40s, they're like, oh my God, this is 2000 all over again. Tech crash, everything's going down 90%. Everybody else is like, well, obviously, what a recession means is that all the banks go bust, everything goes bust. That's not normal. My first recession was 1990. Stock market went down 28%, GDP growth contracted by 2%, house prices fell, and people got tipped out of jobs. standard recession. Lasted a period of time, the world moved on. That's what I think we've actually got here. It's a very ordinary recession driven by Federal Reserve raising rates and prices going up too fast, which means that people can't buy as much stuff because your wages aren't going as much. And so everything slows down. Where's the big imbalance, right? We don't have this, the banking system got sorted out a lot. They're just not allowed to lend as much money. So we don't have those imbalances. So it's very hard to see what's really going to blow up. Now, the bears who are still going, oh my God, this is the worst thing ever, are saying, well, earnings need to come down further. And therefore, we've got another leg lower. This is 2000 all over again. We're just not the same level of overvaluation of stuff. Yeah, we were overvalued, but that whole COVID boom has come off. If you look at something like ARK, it's gone back to where it was. Crypto has corrected to the bottom of its logarithmic channel. Everything's got back to where it should be. I think this is a false narrative that the level of interest rates matter. What really matters is the rate of change. So when interest rates go from 0.5% to 4%, you really notice it fast until you adapt, right? So companies get a bit leaner, they're able to afford stuff, all that kind of stuff. But I don't think a 4% level of rates stops companies being built or growth happening or anything else. So I'm not sure that that's really the case, that the interest rate issues stop this. And, do you think you would not invest in AI because interest rates are 4%? No, that's bananas. Unfortunately, the markets usually recover before that. So, and particularly if the Federal Reserve are saying, look, we want to be tighter for longer, it means that growth coming out of the recession is going to be slower. So I don't think there's going to be a new rush to hiring. We'll probably see unemployment rising. I don't think ad spend comes back quickly because everyone's dealing with, we got too many people, not enough demand going on. So it probably plays out over the course of 2023 and into 2024. While the real recession might have ended by, July or September or whatever, 2023, we've still got the follow-on effects. And that thing is always where it feels a bit slow and not great. Markets can recover fully. Yeah, and if you look through these cycles, they tend to, the first year, once liquidity turns again, tends to be pretty positive. There'll be some choppiness as well. So it's not a up-only market. And then the year after that, when the Federal Reserve's dealing with now kind of sticky unemployment, growth that's not great, that's when they kind of tend to do a bit more QE, maybe chuck in another couple of rate cuts. And that's usually when the market goes, great, it's all over, and we go off to the races. So, it's not an instantaneous V shape. We'll all get back to full bags again, but it'll feel a lot better over the course of this year. A bit shaky. So every time the market sells off, everyone's going to see it's going back down to the lows. We're all screwed. I don't think so. The social token thesis still stands, but it's harder to execute for people. So I do think that many communities will be tokenized communities, these digital nation states that I've talked about and Balaji's talked about, all that kind of stuff. It is coming, but I think what people have found is securities laws and other stuff make it easier to use NFTs to do that initially. So you can start with a smaller nation state by using NFTs. So I think we've seen that, and we're seeing the ability to get NFTs out at scale for very cheap prices. And Ticketmaster are the first people to really do that. I mean, they've got 10 million NFTs out, which nobody realizes, right? Nobody realizes we should be thanking Ticketmaster. We're too busy shouting at them over Taylor Swift gigs, but really, Ticketmaster did a phenomenal job getting tokens into people's hands. So I think that kind of free giving out of NFTs is the new brand marketing unlock, and it's going to be huge. And I'm sure Tarek, when he comes, who is my colleague at Science Magic Studios, is the president of Science Magic Studios, the business that's based around this, he'll talk much more intelligently about it than I will. So NFTs to me still remain a really big thing. So I think ticketing is a huge way of giving it to a lot of people. I think digital identity is the thing we have to solve in 2 years. So that whether that's, and it probably is an NFT. Now, and it needs to have a zero knowledge proof. Why is that so important, and why is it such the biggest thing in the world? Is we're going to the US election in 2 years' time, and we've just unleashed open AI. We can make text to video instantaneously. And within 6 months, Ahmad and their stable diffusion stuff is going to go exponential with that. So we can basically create any video content we want, and we can create deepfakes. So I can have Carly shilling, US government bonds instead of JPEG, and there's nothing you can do about it, and nobody's going to know whether it's authentic. So we don't know who's authentic online right now, and then we don't know what content is authentic. And it can be same with audio. If you saw that audio podcast between AI
Joe Rogan
and Steve Jobs. Okay, so what and also GPT-3, ask it to write an article in the style of the New York Times, and it does. All you need to put is branding on it. I put it on my Twitter, say, hey, look at this article in the New York Times. Biden's agreed to nuke Russia. Right? Nobody knows what the fuck is true. Right? Going into an election, this is a huge societal problem because we've got state actors involved in this as well. So we've got a lot of bad players who can leverage this technology very quickly, and nobody's ready for it. And I think the only way of dealing with this is authentication of content. So therefore, and authentication of people, which I think is an NFT use case. So I think it's urgent, and I think it has to come from Google, Amazon, Meta, and the big players, which I know nobody wants to hear, but it's the only way of doing this fast enough. But for us with bags, this is good because we're onboarding people in a way that has to happen.